You are listening to Talk Tickers. We do fast-paced, professional, no-fluff earnings analysis.
If you want the signal without the noise, you are in the right place.
Today, we are tearing into the advanced micro devices. That's AMD Q4 and full year 2025 earnings call, which just wrapped up on February 3rd, 2026.
And let me tell you, the tension on this one was absolutely palpable. It was one of those calls where every single word from management was being weighed on a gold scale.
Oh, absolutely. I mean, you look at the setup here. On paper, AMD delivers what looks like a classic beat and raise.
Totally. Record numbers, everything pointing up and to the right.
But then you look at the after-hour session.
Yeah.
And the stock is getting absolutely punished, dropping, what, roughly 7-8% immediately?
It is the classic Goldilocks problem. The market right now, especially when it comes to the AI trade, is just incredibly demanding.
Right.
It is not enough to just be good. You have to be perfect.
Wow.
And while the headline numbers for AMD were fantastic, the quality of those numbers, well, that's where the argument started.
Okay, let's unpack this. Because when a company beats expectations by a healthy margin and the market sells it off, that is usually where the real story is hiding. Why wasn't a double beat enough to satisfy a market that is absolutely hungry for this AI trade?
It comes down to the quality of the beat. The headline numbers were great, but when investors started looking under the hood, specifically at some one-time boost from China and some complex inventory accounting, the picture got a little messier.
Got it.
We're going to get into the low-quality nature of this beat, the absolute explosion in the data center, and stick around because at the end, we have a very specific, not financial advice trade idea regarding the 2027 timeline that you do not want to miss.
It is a contrarian take for sure, but let's start with the scoreboard. What actually happened? Give us the snapshot.
Top line, revenue came in at $10.27 billion. The street was looking for $9.67 billion. So that's a massive beat.
And it represents 34% year-over-year growth. That is huge growth for a company of this size. I mean, usually when you get to this market cap, growing at 34% is incredibly difficult.
It is. And the profitability metrics followed suit. Non-GAAP EPS hit $1.53, which beat the consensus of $1.32 by 21 cents. And GAAP net income was $1.51 billion.
So revenue is up, profits are up. But in the semiconductor world, margins are the religion.
Always.
If you don't have the margins, you don't have the valuation. What happened there?
The headline non-GAAP gross margin was 57%. That is up 300 basis points year over year.
Wow.
And for context, a 300 basis point move in manufacturing efficiency for a hardware company is massive. Operating income hit a record $2.85 billion.
Okay, so far I am hearing nothing but good news. If I just read the press release, I am buying the stock with both hands.
Right.
So let's break down the segments before we get to the, the ugly part. Who carried the team?
Data center. No question. It is the star of the show.
Okay.
Revenue was $5.4 billion, up 39% year over year. But here is the number that matters more.
The sequential growth.
It was up 24% just from the previous quarter.
That sequential growth is key, right? Because that shows the acceleration is happening now.
Exactly. It shows demand is compounding. And then you have the client segment, that's your PC chips, which was also strong. Revenue of $3.1 billion, up 34% year over year.
So people are finally upgrading those old laptops.
The AI PC cycle is real. But then there is gaming.
The drag.
The anchor. Revenue was up year over year, technically, but it was down 35% sequentially.
Oof.
The console cycle is slowing down fast, and it is pulling on the rest of the show.
So data center booming, gaming slowing. But here is the million-dollar question. If the revenue beat by over $500 million and margins expanded to 57%, why did the market hate it? Why the 7% sell-off?
This is where we have to put on our forensic accountant hats. This is the quality of earnings debate, and it is the main reason the bears took control after the bell.
This is the China factor, right? I saw this flying around the forum.
That's the one, exactly. So in the Q4 numbers, AMD disclosed a very interesting nuance. Revenue included approximately $390 million of sales of the MI308 product to China.
Okay, just for context, remind us what the MI308 is.
So because of U.S. export controls, companies like AMD can't sell their top-tier, most powerful AI chips to China.
Right.
So they create these cut-down versions that comply with the regulations. The MI308 is that compliant chip for the Chinese market.
Okay, so they sold $390 million worth of compliant chips. Why is that bad? Revenue is revenue, right? Money is green.
Usually, yes. But here's the kicker. That inventory had been previously reserved.
Reserve.
Basically, in a past quarter, AMD said, we might not be able to sell this stuff because of regulations, and they wrote down the value. They took the hit back then.
So the cost was already accounted for in the past.
Precisely. So when they finally did sell it in Q4, they released those reserves. And when you release an inventory reserve, it flows directly into gross profit with zero associated cost in the current period.
Wait, zero cost?
Zero. We are talking about a $350 million benefit just from releasing those reserves.
I see. So it's a $360 million injection of pure profit that didn't come from selling something at a normal margin today.
No.
It came from cleaning up the books from yesterday.
Correct. And that distorts the margin picture. That headline, 57% gross margin, it was boosted significantly by this one-time event.
Okay.
If you strip out that inventory release and those specific China sales, the real non-GAAP gross margin would have been around 55%.
So the headline says 57%, but the operational reality is 55%.
And that is why the market viewed this as a low-quality beat. Investors want to see margin expansion coming from pricing power, from efficiency, from selling the MI300X at a premium. They don't want to see it coming from releasing old inventory reserves. It made the beat feel, artificial to some.
It's like finding a $20 bill in your winter coat pocket. It's great you have 20 extra dollars, but you didn't earn it.
You can't count on it.
So you can't count on finding another one next week.
That is the perfect analogy.
Yeah.
And that plays directly into the guidance, which we will get to. But first, we have to talk about the bull case.
Okay.
Because despite the accounting noise, the AI story is actually accelerating. The bears are focusing on the accounting, but the bulls are looking at the roadmap.
Let's talk about the hardware then. The MI350 ramp. Is it happening?
It is ramping well.
Okay.
But the really exciting stuff is the forward-looking roadmap. Management confirmed the MI450 launch is on track for the second half of 2026.
And this isn't just about selling at ship anymore, is it? The strategy has shifted.
It has. This is a critical evolution in AMD's business model. They are moving to what they call rack scale.
Rack scale.
They aren't just selling you a GPU, they are selling the Helios rack. This is a system-level sale.
Why does that matter? Why can't they just sell the chips?
Because if you want to compete with NVIDIA, you can't just sell the engine. You have to sell the whole car. NVIDIA sells the DGX, a supercomputer, in a box. That's plug and play. AMD is finally catching up. With Helios, they sell the GPUs, the CPUs, the networking, the cooling, everything integrated.
They announced partnerships with HPE and Lenovo for this, right?
It did. It captures more revenue per customer, and it makes the customer stickier.
It's harder to switch away from a whole rack architecture than it is to just swap a chip.
Exactly. And speaking of validation, there was one specific detail in a call that I think got buried by the China news, but it's actually massive.
Which was?
The partnership with OpenAI.
I saw that. They mentioned a multi-generation partnership.
They did. But did you catch the number they attached to it?
No, I missed that.
A 6-gigawatt deployment of Instinct GPUs.
6 gigawatts.
6 gigawatts.
Put that in perspective for us. That sounds like a lot, but how much is that really?
That is an enormous amount of power. A standard large data center might consume 50 to 100 megawatts.
Yeah.
A gigawatt is 1,000 megawatts.
So we're talking about the power equivalent of roughly, 60 to 100 massive data centers?
Exactly. Dedicated just to this deployment. That is the power consumption of a small city.
That is staggering.
It is. And what it tells you is that this isn't a pilot program.
Yeah.
OpenAI isn't just testing the waters with AMD.
No.
You don't secure 6 gigawatts of power for a science experiment. That is we're building the future on this hardware partnership.
Okay.
It validates the technology, the ROCm software stack, the hardware reliability in a way that almost nothing else could.
So if you are a bull, you were looking at that and saying, the smartest AI researchers in the world are betting the farm on AMD chips.
Precisely. And that is why the sell-off might be short-sighted. But we have to look at the whole picture. So you have OpenAI locking in massive capacity. You have the MI450 coming later this year. What about the boring stuff?
Yeah.
The server CPUs.
The EPYC chips.
Do not sleep on the boring stuff. The Turin processors, that's the 5th gen EPYC, are accelerating.
Okay.
Server CPU revenue actually grew sequentially in Q4.
Why is that surprising?
Because Q4 is usually a seasonally down quarter for server CPUs.
Yeah.
Budgets are exhausted. Companies are waiting for the new year.
So growing sequentially is a big deal.
In that environment, it tells you that while everyone is looking at AI GPUs, the traditional data center backbone is still growing strong for AMD. They are continuing to take market share from Intel.
So we have this tug of war. On one side, you have the low quality earnings beat driven by one-time China sales. On the other, you have massive structural growth in data center and a monster validation from OpenAI. Let's look at the other side of the house again, client and gaming.
Right.
We touched on them, but I want to dig into that gaming guidance.
It was brutal.
The language they used for 2026 was stark.
It was. They guided for semi-custom revenue, that's the chips for PlayStation and Xbox,
Yeah.
to decline by a significant double-digit percentage in 2026.
Significant double digit. That is corporate speak for it's going to fall off a cliff.
It means 20, 30, maybe 40% down. But we have to remember, we are entering the 7th year of the console cycle. This is the natural life cycle.
True.
The current consoles are old news, saturation is high, and the next generation isn't here yet. It creates a massive revenue hole that the data center has to fill.
It's dead weight for now.
And inventory rose slightly too, right? Up to $7.9 billion.
Is that a concern? Usually, rising inventory is a red flag.
In this case, management says it is to support the data center ramp. Given the demand signals, like that 6-gigawatt number, it makes sense.
Okay.
If they were building up gaming inventory, I'd be terrified. But building up GPU inventory, that's just loading the gun for the next battle.
So let's talk about the future, the guidance. This is usually where the rubber meets the road. They guided Q1 2026 revenue to about $9.8 billion.
Which is down about 5% sequentially, though up 32% year over year. But here's the catch, and this goes back to the quality debate.
Let me guess, China.
That Q1 guidance only includes about $100 million of China sales.
Compared to the $390 million in Q4?
Exactly. So you have a nearly $300 million headwind just from that one line item dropping off. Management called the China situation dynamic.
Uh-oh.
And they are explicitly not forecasting anything beyond that $100 million.
Dynamic is never a word you want to hear an executive VP use about a revenue stream.
It means we have no idea.
It essentially means we have no idea if the government will let us sell this stuff next month.
It introduces uncertainty, and markets hate uncertainty. But Lisa Su did recommit to the long-term goal. She is still talking about tens of billions in AI revenue by 2027.
Okay.
And a greater than 60% CAGR compound annual growth rate for data center over the next 3 to 5 years.
That is a bold number. But the market is comparing them to NVIDIA, right? It always comes back to NVIDIA.
It does. And this is the problem. NVIDIA has structurally higher margins because they sell complete systems with a mature software moat. They have pricing power that is basically infinite right now. AMD is trying to pivot to that system-level sale with Helios. But right now, investors are looking at that 55% real margin and comparing it to NVIDIA's mid-70s.
And they are saying, show me you aren't just the cheap alternative.
Exactly. They want proof that AMD is a premium competitor.
Yeah.
And they want proof that the supply chain can hold up.
Right.
Management said they have secured supply for the aggressive 2026 ramp HBM memory, CoWoS packaging, but the execution risk is on AMD. They have to deliver, and they have to deliver at scale without these accounting asterisks.
The AI supercycle narrative is still intact, clearly, but the bar for what constitutes a good quarter has been raised impossibly high.
For sure.
You can't just beat. You have to beat with high-quality recurring revenue or the market punishes you.
That is the lesson of this quarter.
Okay, that brings us to our favorite segment. We have looked at the numbers, we have analyzed the strategy, we've dissected the accounting. Now, let's get speculative.
Disclaimer time.
Yes, huge disclaimer. This is not financial advice. We are not your financial advisors. This is for entertainment purposes only. Do not trade based on what we say.
Please don't.
We are just two voices on a podcast trying to make sense of the madness.
Okay, now that the lawyers are happy, let's talk about a trade idea I like to call the 2027 convergence play.
I like the sound of that. It sounds ominous and profitable. What's the setup?
We are looking at a specific convergence of catalysts that hits in late 2026 going into early 2027. We are basically betting on a specific timeline.
Okay, lay it out.
First, look at the AI roadmap, the MI500 series. This is the next big Leap CDNA 6 architecture built on the 2-nanometer process.
2 nanometer, wow.
That launches in 2027. That is going to be the chip that powers the next wave of massive multimodal models. It is the chip that finally catches up to NVIDIA's next-gen architectures on a process node basis.
Okay, so you have a massive product cycle hitting in 27. The tech is peaking. What's number 2?
Second, look at gaming. We just said 2026 is going to be a significant double-digit decline.
The bottom.
That is the bottom. It is the valley of death for the gaming segment. But what happens after the bottom?
The next generation, the hype cycle.
Exactly. Management explicitly mentioned the next-gen Xbox is targeting 2027. So Right as the gaming revenue clears the decks and resets, washing out all the bad numbers in 2026, you get the hype cycle for the new consoles starting to build.
So you have the AI peak with MI500 colliding with the gaming bottom, resetting into a new cycle.
Precisely. You have a Goldilocks moment in reverse. 2026 as messy margins are compressing because of the China drop-off, gaming is tanking. It creates a valley of death in the stock price, or at least a lot of sideways chop, where the stock goes nowhere, the market gets bored.
So what's the trade? How do you play that boredom?
You play the convergence, you look at a calendar spread or maybe a lead strategy. You are looking at buying deep out-of-the-money calls for mid-2027.
You are betting on the coiled spring.
Yes. You are essentially saying, I am going to ignore the noise of 2026. I am going to ignore the messy margins, the China accounting issues, and the gaming slump. I am betting that by the time we get to early 2027, the narrative will have shifted entirely to two-enemied AI dominance plus new Xbox supercycle.
It's an ignore the noise trade. You use the 2026 dip, maybe the dip we are seeing right now, to position for the 2027 explosion.
It is wild, it is risky, and you have to have diamond hands to hold through the chop. But if that convergence hits, the narrative shift could be massive.
I love it. It connects the dots between the two most disparate parts of their business, AI and gaming. Again, not financial advice, but definitely something to think about while you're watching the ticker tape.
Absolutely. It's about playing the cycle, not the quarter.
So to wrap this up, AMD delivered a record year and a record quarter, $10.27 billion in revenue.
Huge numbers.
But the quality of those earnings, specifically the China revenue and the inventory reserve releases, gave the bears enough ammunition to take profits and drive the stock down 7-8%.
The company is executing on product. The MI350 is ramping, the MI450 is coming, and that OpenAI partnership is a huge vote of confidence.
It is.
But the financial optics are messy right now.
Yeah.
2026 is going to be a transition year. They have to prove they can maintain those margins without the one-off helps.
They have to prove durability.
They do. And until they do, the stock might be in the penalty box for a bit.
A fascinating setup, for sure. What stands out to you? Is the China issue a deal breaker, or is it just a speed bump on the road to tens of billions in AI revenue?
That is a question every investor needs to answer for themselves.
If you enjoyed this breakdown of the China asterisk and the deep dive into the numbers, do us a favor and rate the show. It helps other learners find us.
And keeps us digging through these transcripts so you don't have to.
Exactly. Signing off from Talk Tickers. We'll catch you on the next deep dive.